There's such a fine line, making money and losing money in the market.
We want to teach you the concepts.
You have to be okay with the type of trader that you are.
We want to teach you the processes.
This is what really gives the meat and potatoes to it.
We want to teach you how to.
The bottom line is you want to make money trading.
I can promise you that I can make you a better trader.
Join T3 Live at the Boca Raton Hotel and Resort April 26th and 27th for an exclusive trading education event. Sign up now.
Good morning, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the morning call on a Friday, which is Jobs Friday, and it's turning into a little bit of a dark Jobs Friday, not just because of the weather outside, but the number came in extremely disappointing. We were expected to add 190,000 non-farm payrolls today, and we only added 88,000. The futures were already lower heading into that report and then have accelerated to the downside since the report was released. We had some upward revisions in some previous months, but not enough to really dull the pain of this extremely disappointing number. We also saw the unemployment rate tick down from 7.7% to 7.6%, and with the non-farm payrolls coming in disappointing, what that tick down in the unemployment rate tells you is that people are leaving the labor force. You have discouraged workers who are looking for work and aren't able to find it, and after people stop searching for jobs, they exit the labor force. That's how the unemployment rate is calculated. So you have sort of a double whammy of bad news, even though maybe the non-seasoned market participant might look at the drop in the unemployment rate and think that is the most important number that's coming out of this morning. But the most important number for traders and people who are familiar with the market is that non-farm payrolls number, and that came in extremely disappointing. And we continue to trade lower. When I walked in here, we were continuing to tick lower in the spiders and the S&P and all the indices. But let's go ahead and take a look at the chart of the spiders. Wednesday we closed at all-time closing highs in the S&P and the Dow, and I walked in to do the daily recap on Tuesday, and I said, I know we have all these headlines of all-time highs and everything, but I feel much more comfortable with shorts right now than I do with longs, and I feel like the risk-reward ratio that we always talk about and always focus on as traders is much more heavily skewed in favor of shorts after Tuesday's close. And then Wednesday we happened to get that big sell-off, more than 1% loss in the S&P and the Dow, or in the S&P and the NASDAQ. The Dow was down, I think, 0.8%. And then yesterday it seemed like the market was just really quiet, waiting for today's jobs number. And in off the charts last night we said, this morning's job report is really going to provide clues or cause us to either have another leg lower or probably rally back to highs. And obviously we've seen what resolution we got to that this morning. But we're going to go ahead and take a look at the 5-minute chart of the spiders just to give you an idea of where we are pre-market. We're all the way down here below 154. You have S&P futures down more than 10 handles. Not able to get much of a bounce this morning after that non-farm payrolls number. Normally if you see a big tick down like this, you can sometimes see a snapback, but we haven't seen that so far this morning. It'll be interesting to see whether we can find our footing during the session. So we're here at 153.90 in the pre-market, and we'll go back to the daily chart and see what level that sort of corresponds with. And you see right here, there's no real, it's into this gap from the beginning of March. There's no real support besides that. I think a gap fill down to the 50-day moving average seems like a logical place for this market to go right now. And we're not there yet in the pre-market, so be wary of potentially more weakness. I wouldn't blindly buy this open, but I think you're sort of, from a short perspective, you're sort of stuck with what you came in this morning with. Sort of hard on this big down open and just off the opening bell, just pile into more shorts. Like I said, you're sort of stuck with what you got, and I would wait for a base to form in the morning, and then you could potentially look to either buy dips in stocks that are showing relative strength, or if the market's not able to tick up, you could potentially look for relative weak stocks to short, potentially for the market to get back down into that gap and into the 50-day moving average. But one thing we talk about when the market's sort of in turmoil and you have a big down open like this that could induce some panic is that narrow your focus. Don't trade multiple stocks in multiple sectors. Maybe pick one stock in each sector, or even just focus on a couple sectors that you really like and focus on trading those stocks. We're going to take a look. One of the reasons on Tuesday why we talked about the fact that, or I talked about risk reward was skewed in favor of The short side is that we've seen some really faulty signals in several sector ETFs. And one of the main ones, if we go to the chart, is the IYM, which is the Russell 2000 small cap index. And you see this heavy selling that we've seen the last 3 days, or we saw early this week in the IWM. That's a huge red flag. Small cap stocks are seen as a gauge of risk appetite. And so when you see small caps selling off, it's sort of a sign that you have some sort of risk off scenario taking place and people taking profits on potential riskier. I mean, small cap stocks have potentially more reward, but they're also riskier, so people looking to take profits in those. You had the IWM break its 50-day, and then yesterday it came back up and to retest it. Obviously going to be sharply lower this morning. The low of yesterday and of Wednesday is around 90.96. We'll go to the 5-minute just to see where that is pre-market. We're below that, obviously, so it'll be interesting to see whether we get more downside acceleration in the IWM. The other one that was showing extreme relative weakness that we talked about was the IYT. The transports index also broke its 50-day on Wednesday after 3 days of heavy selling. Yesterday came back up and to retest it. We'll take a look at the 5-minute chart to see where, well, I guess it's not really showing much this morning for us, but that'll obviously be sharply lower. Another one, watch yesterday's low as your pivot to see if we are able to retest it this morning, but just another sign of technical damage that we were looking at. The XHB, the home builders, another one that was showing extreme relative weakness. This has been one of the sectors that was leading the market for the greater part of 6 months, from that November low up through March. And then on Wednesday is when you had the real downside acceleration, the XHB, a very definitive break of that 50-day moving average. Yesterday, like all the indices, pretty much just sort of felt like it was resting and waiting for this morning's jobs report. But it's felt like just a pause, and obviously we're down this morning. Interesting to see what happens with the XHB. One interesting thing I want to talk about this morning is gold, which we've obviously been talking about how gold has been extremely weak. We're going to go out to a weekly chart and look at the macro level on gold. It's coming into a huge level, obviously. If you zoom out all the way back, it's tested this level multiple times since breaking out in 2011. And you sort of have a macro descending triangle pattern formed in gold right here, and it's coming into the floor, which could either be a spot where, depending on your perspective on gold, that you look to buy a strong support level, or you look for a potential inflection point that could lead to more acceleration to the downside. But this morning, when we go back to the daily chart on gold, this morning gold is up, and I'll take a look at the 5-minute just to see where gold is pre-market. But yesterday, it opened sharply lower again, pretty healthily lower, but was able to trade a little bit higher. And then this morning, we take a look at the 5-minute chart. Gold is up around 150, 170, up near the 152 level, spiking on that jobs report. And we talked about gold becoming sort of a pure fear trade in relation to the market, trading almost completely inverse to the market. That didn't happen on Wednesday, as all assets sold off Tuesday and Wednesday. It's sort of everything was going down. Everyone was shedding assets. But this morning, gold is obviously higher, and it'll be interesting to see whether it gets a bigger bid, given perhaps some fear coming into this market in relation to the economy. And the other thing to consider is that the Federal Reserve has made it very clear that they're going to continue to ease and continue with the quantitative easing program as long as their employment mandate is not met. And obviously this morning's report is a huge issue for our unemployment picture, and doesn't seem like it's the type of thing that's going to lead the Fed to want to pull back on the reins on QE. So I think you'll continue to see QE. You might not see the timeline for that shrink the way people saw the potential for that in 2013. So I think you could get some attention back on gold, and this is a compelling place if you're looking for protection, for inflation, the type of things that the Fed could be inducing. And then you have the Bank of Japan with their unprecedented $1.4 trillion easing program that was announced yesterday. You have a lot of inflationary forces out there in the market that could push gold and allow you to buy the dip on gold and cause gold to bounce. So I think this might be a compelling area if you're looking for a little bit of a contrarian trade, something that could have some meat on it for a bounce. I think gold is something you should really consider. From the short side, sort of like I said, you have what you came in with this morning, but I think there are some stocks that you should watch to see how they base during the morning to potentially look for more downside. But one of the ones in the financials that I talked about being my favorite short in that sector is Morgan Stanley. And if we go to the chart of Morgan Stanley, it's into that gap. It's filled a lot of that gap from mid-January, but it's still got some room to fill down. It's lower this morning, obviously below Wednesday's low. We'll make sure that Wednesday's low is 2095. We'll take a look at the 5-minute chart. It's down at 2080, so obviously below that low. It's lost that support. It looks like it's going to fill that entire gap. That could be the end of that trade to the short side, but based on the action in the financials overall, and then Morgan Stanley, which has been one of the weakest among the financials, I really wouldn't be surprised to see it test the 200-day moving average, which is down here at 1920, especially as the European debt crisis and stuff starts to rear its ugly head, and then you have unemployment. Very disappointing this morning. The banks, I think, could come under some pressure, and Morgan Stanley is my favorite short among them. Goldman Sachs is the other one I've talked about being weak in the sector that I think could potentially have more downside. It's below yesterday and Wednesday's low as well. Not much support as you had this sort of steady climb from mid-December up to the beginning of February. So the 200-day moving average is a little further away for Goldman Sachs, and I don't know if I would necessarily expect Goldman to test this 200-day moving average, but I think this is one that could potentially see more downside for maybe a cash flow type of trade. And then you talk about Apple. Apple, I think, is sort of just out of play for traders, but it's one that has been weak. And if you strictly pay attention to technicals, Apple seems like a short to me here as it comes into this pivot low of 419. And we'll look at the 5-minute chart of Apple this morning. It's not down huge with the market. It's holding up relatively well, around the 420-450 area. But it'll be interesting to see if Apple gets more downside pressure, how it treats that 419 area. Something traders might be watching is Apple's always somewhat in focus, for better or for worse. Another one potentially to the short side, if you see a base this morning, is BIDU. It gapped down and has traded lower since that earnings gap, acting very weak. It's a little bit hard to trade sometimes. It frustrates traders from time to time, but I think on a swing basis, BIDU is headed lower. It's broken below this support area, sort of put in an ascending channel type of flag right here, and it just really looks like it's rounding a rounding top here overall on a macro basis in BIDU. And you have this short-term flag to base your short out of. It broke out of it Wednesday. I think you could see it test this low. We'll look at the 5-minute just to take a look. 83.31 is the low of the pivot low here of this candle. We'll look at the 5-minute. It's just above 84, so it'll be interesting to watch BIDU today. Whole Foods Market. Another one we talked about. Scott talked about it in the morning call earlier this week as a short candidate. A similar situation with BIDU is that it gapped down, traded lower from the gap, and then broke out of, you sort of see a channel right here that it broke lower out of. Some of this trade might be a little bit cooked as it's broken this pivot low area, but another one that if you're looking for relatively weak stocks, this is one of them. You might be gone a little bit too far to the short side to short now, but want to keep an eye on. And then Netflix and LinkedIn are two that I talked about that we don't typically look to short the strongest stocks in the market while they're in upper level bases, but both Netflix and LinkedIn started to look really exhausted after enormous moves after their earnings reports. And I talked about this important upper floor in Netflix as a potential trigger short area, and we got a nice downside from that as we broke the 821-day and 50-day moving average. It wasn't able to bounce at all yesterday while the market was it was able to bounce a little bit and trade in a range. I think Netflix could see more downside to potentially challenge the beginning of this gap at some point around the 140 area. I wouldn't be surprised to see it down there in the next few weeks, especially if this weak jobs report and today's sell-off leads to a bigger correction. And you look at LinkedIn, as far as today goes, I think this is one that you could potentially look to short after a retest of the 8 and 21-day moving average yesterday. It's a little bit of a riskier scenario. I think somebody just took away my charts here, but it's a riskier scenario because of the macro relative strength that LinkedIn has shown, but I think it's one that looks like it's run out of steam at upper levels and could see more downside. Somebody took away my charts here, somebody logged into my account, but two stocks that if you're looking to buy the dip that I think, we're not going to be able to look at the charts, but that I think are compelling right now. One is Facebook. After that announcement yesterday, you saw Facebook was able to break out of its descending channel that has been in place for a while now, as it's shown relative strength to the market. And I think because of that news, it's going to be a little bit separated from the rest of the market. And I think it's one that you can potentially play for some continuation of the upside. It's probably going to open lower this morning as well with the market, because the magnitude of this sell-off is probably too much to ignore for individual stocks. But that's one, if you're looking to buy dips, that's one I think would be a good candidate. And another one is Nike. It's one that Scott is long, one we've listed on Off the Charts. And it looks like it has a nice upper level pattern and could potentially get more upside. But overall, like I talked about in the morning, the beginning of this video, is that when you get turmoil in the market, potentially panic, narrow your focus. Maybe, I don't believe that trading the indices you have much of an edge in general, but on days like this, you might focus a little bit more on the indices, look at support levels, look at key pivot areas, and if you're going to trade stocks, limit your focus to one in each sector, or just a couple stocks. Don't even trade all the sectors, but just limit your focus. Focus really narrowly on the short-term price action in the morning to see whether it feels like we're going to get more downside, or whether it feels like we're going to get a resilient response from this market that has been extremely resilient so far in 2013. But I know all the guys on the virtual trading floor will be all over it. This is where Mark Sperling, Scott Redler really make their living in days like this, where there's a lot of opportunity and a lot of volatility. So if you're a subscriber, make sure to be in there when the opening bell rings, and we'll see you back here for the daily recap today to see how the day goes.
I'm Mark Sperling, Director of Trading with T3 Trading Group and contributor to T3 Live. Do you trade on your own, but you wish you enjoyed the benefits of a large trading floor? With the T3 Live virtual trading floor, we deliver that experience to you on your computer. On the VTF, you can follow the long and short positions of experienced professional traders like myself, Scott Redler, and others, and listen to our live radio stations as we navigate the markets. In addition, you get the added value of a large community of sophisticated and like-minded traders. Your membership to the virtual trading floor also includes access to our two very popular newsletter products, Off the Charts and the Price Point Sheet, at no additional cost. In my opinion, joining the room will be the best trading decision you will ever make. I would like to invite you to begin your membership with a 7-day free trial. To get started, visit t3live.com and click on the Virtual Trading Floor tab. Have a great day, and I look forward to seeing you in the VTF. I'm Mark Sperling, Director